Hey there, and welcome back to our channel. If you're new here, I'm your name, and today we're diving into a crucial topic that can help secure your financial future: financial buffers. Whether you're saving for a big purchase, planning for emergencies, or just trying to make sense of your finances, having a financial buffer can make all the difference. So, let's get started. But first, let me ask you this: have you ever found yourself in a tight spot financially? Maybe your car broke down unexpectedly, or you had a medical bill that you weren't prepared for. How did you handle it? Today, we'll explore what a financial buffer is, why it's important, and how much you really need. First off, let's define what a financial buffer is. A financial buffer is essentially a safety net, an amount of money set aside to cover unexpected expenses or emergencies. Think of it as your financial cushion. It's there to help you avoid debt or financial stress when life throws you a curveball. Now, you might be wondering, how much do I actually need? The answer can vary greatly depending on your personal situation. But a common rule of thumb is to aim for 3 to 6 months' worth of living expenses. For high-risk jobs or single-income families, 6 to 12 months is often advised. Let's break that down a bit. Living expenses can include rent or mortgage payments, utilities, groceries, insurance, and any other monthly bills. For an average US household, this totals around $2,500 to $4,000 per month. So, for example, if your monthly expenses total $3,000, you'd want to have between $9,000 and $18,000 saved for your financial buffer. Sounds like a lot, right? But let's put it into perspective. According to a survey by Bankrate, about 57% of Americans can't cover a $1,000 emergency expense without borrowing money. This is a staggering statistic. It highlights just how vital it is to have a financial buffer. Imagine having to borrow money or rely on credit cards for an unexpected car repair, which can cost $500 to $2,000. Not only can this lead to debt, but it can also impact your credit score. The Federal Reserve reported in 2022 that 37% couldn't cover a $400 surprise expense. So, how can you start building your financial buffer? Here are a few practical steps. Step 1. Set a target. Determine how much you want to save in your buffer. This could be a percentage of your income or a specific dollar amount. Having a target will help you stay focused. Consider starting with a mini-goal, like a $1,000 starter fund, as recommended by financial experts like Dave Ramsey. Step 2. Create a budget. Track your income and expenses to see where you can cut back. Even small savings can add up over time. For instance, if you save just $50 a week, that's $2,600 a year. Many financial advisors suggest budgeting 20% of your income to savings, following the 50 to 30 or 20 rule. Step 3. Open a separate savings account. This way, your financial buffer is not mixed with your regular spending money. Look for an account with a high interest rate so your savings can grow a little over time. High-yield accounts can offer 4 to 5% APY, significantly more than typical checking accounts. Step 4. Automate your savings. Set up automatic transfers from your checking account to your savings account. This way, you won't even have to think about it. Out of sight, out of mind, right? Even micro-savings apps like Acorns can help by rounding up purchases, adding up to $50 a month. And finally, Step 5. Review and adjust. Life changes, and so do your expenses. Regularly check in on your buffer to ensure it meets your needs. If you get a new job with a higher salary, consider increasing your buffer as well. Tracking your expenses for 3 months using apps like Mint can help with this review. Now, it's important to remember that a financial buffer is not just for emergencies. It can also provide peace of mind. Knowing you have a safety net can reduce stress and help you make better financial decisions in your daily life. This could mean the difference between making a rash decision due to financial pressure and being able to think clearly about your options. And before we wrap up, let's talk about some common misconceptions about financial buffers. Myth: I don't need a buffer if I have credit cards. Fact: credit cards can help in emergencies, but relying solely on them can lead to debt and high interest payments, with average APRs around 21.5%. A buffer is a more stable and stress-free option. The average US credit card debt is $6,300, emphasizing the risk of relying on cards. Another myth: I can't save that much, so why bother? Fact: even small amounts add up. Start with what you can and gradually increase it. The important thing is to start saving. Even $10 a week can make a difference over time. And remember, 49% of US adults live paycheck to paycheck, so you're not alone in starting small. So, to summarize, a financial buffer is your safety net against unexpected expenses. Aim for 3 to 6 months of living expenses, set a target, create a budget, and automate your savings. Remember, it's not just about saving, it's about securing your peace of mind and protecting yourself from financial shocks like job loss or medical emergencies. If you found this video helpful, please give it a thumbs up and share it with friends who might benefit from it. And don't forget to subscribe for more financial tips that can help you navigate your financial journey. Until next time, take care and happy saving!